Very warm welcome, everyone. Thank you for joining us today for our webinar, An Empirical Evaluation of AI-Powered Signal Optimization for Investment Management. I would like to begin by introducing our speaker. Julian Brooke is a senior machine learning engineer at Boosted.ai. He has a PhD in computer science from the University of Toronto, numerous publications in the subfield of natural language processing, and holds 3 patents to his name. Before joining Boosted.ai, he most recently taught data science at the University of British Columbia, and prior to that, he was a research scientist in the cognitive computing group at Thomson Reuters. Without further delay, I'll now pass it on to Julian.
Okay, thanks very much for that introduction, and thanks everyone for coming today. So the subject of my talk is signal optimization, which is part of our portfolio construction pipeline in our platform. So I'm going to give you a little bit of background in how our portfolio construction works, and I'm going to give you some details on how signal optimization part of that platform, that pipeline works, and then I'm going to focus on actually sort of my main contribution to this work, which is a battery of experiments that we ran to show that signal optimization helps us find a good risk return trade-off. Okay, so I actually took this slide from an earlier webinar that we did. We haven't talked a lot in our webinars about portfolio construction, although there it is, right there in the middle of the pipeline. Of course, the core of our product is ML stock prediction here, but for many of our customers, even if they aren't directly training with using our stock predictions, they're interested in seeing how their models work. And to get from the predictions down here to the post-trade analytics, portfolio construction is one of the key steps of that process. And also for us today, when I'm doing my experiments, I'm able to do portfolio construction and then go downstream and give you some results using these standard measures like alpha and Sharpe. So let me go into a little bit about how our portfolio construction works, but I first wanted to start off with something that probably comes to many of your minds when you think of portfolio construction. This is sort of the classic work on how to build a portfolio, and I wanted to sort of use it as a starting point and then contrast it a little bit with what we do in our product. So first of all, this is on the left side here is this is the prettiest picture I could find on the internet of the efficient frontier, Markowitz efficient frontier. So many of you will be familiar with this. This line is supposed to represent sort of the optimal portfolio we can find given a sort of trade-off between sort of a risk averseness that we have to the market. Now, one of the good things about portfolio, one of the things that sort of motivates portfolio construction is the fact that this line is actually this curved, bulgy line, which means there's sort of gains to be had. Like risk return is not a zero-sum game. We can actually find portfolios that find a good balance between risk return that actually sort of give us a nice high Sharpe relative to what we would get if we just focused on risk and focused on return. And so that's what we're interested in, much like that original work. I wanted to go a little bit through on this. This is an equation. Again, many of you may have seen this equation or some version of it. This is the standard equation that helps us find this this efficient frontier. The idea is that we want to find a stock allocation, which I'll use the term allocation or weight in the context of this talk. We want to find a portfolio, a distribution across the stocks in our universe that minimizes this equation here. Now, there are 2 parts of the equation, one corresponding to risk and one corresponding to return. So first of all, this is an optimization problem, and it's actually in that respect somewhat similar to what I'll be talking about later when we talk about signal optimization. So it's also a minimization. The parts of it, again, are also, we'll see, very clearly relevant to what we do later. The specific bits of it, I will talk a little bit about these specific numbers mean, these specific symbols mean here. So lambda here is a risk averseness measures of how much we want to be along this, where we want to be on this curve. Do we want to be more, we want to reduce risk, or do we want to have higher return? Maybe if this morning, I feel many of us might be sort of feeling on the risk averse end after what has happened yesterday. The other pieces of this equation, other than the DW, which again refers to the allocation. The sigma here is a covariance matrix. It represents sort of two key aspects: overall volatility of stocks and also the correlations between various stocks. It's a matrix. It's a stock by stock matrix, which represents correlation and general volatility. The other part of this on the return side, this EER, is expected returns. This is a prediction about how we think particular stocks will do in the future in terms of specific values of returns in future trading sessions. So first of all, this is a beautiful equation. It's a one-stop optimization equation. You plug in the pieces of this thing that you need, you optimize this, and you get a portfolio that is supposed to be along this frontier. It's classic. It's still used in many contexts, and there are certainly advantages to doing sort of one-stop optimization. That's not actually the approach that Boosted AI takes to portfolio construction. One of the negatives, though, is that although it's in some sense, a simple equation, it's actually a very difficult equation to optimize. And especially if you consider not just the sort of simple elements here, purely risk versus return, but also many kinds of other things that you might be interested, for instance, things like turnover, that you may want to consider when you're optimizing your portfolio. So specifically looking at some of these elements here, the covariance matrix I mentioned is, as I said, it's a matrix where it's a stock by stock matrix. So if you're building a portfolio on the Russell 1000, that covariance matrix is a 1,000,000 element matrix, a 1,000 by 1,000 matrix, roughly speaking. And that's actually, if you're considering, if you have a daily model run over, say, over the last 10 years to test out some trading theories, that's actually quite a computational load. And there are other issues with this representation, is that, do you really want to represent your entire market as particular pairs of stock? Does every stock need to be compared to every stock with a single number in your model? This is, in some sense, there's a lot of noise that's injected into this model by having such a detailed representation of the model. So the other, actually, even maybe more problematic part of this equation is this other one, the expected returns. So now, of course, the future is hard to predict. And predicting particular numbers in the future is particularly hard. So our experience doing this has found that, actually, I want to say first that the original Markowitz approach to expected returns was mostly based on just doing like a mean, which is very, very naive. Now, we have ways of doing it, approaching this prediction of expected returns using more sophisticated techniques. But our experience in this area has found that actually this is kind of a dangerous thing to do. That actually, by trying to predict particular values of expected returns, it actually adds a lot of noise to this equation, because the future is hard to predict and particular numbers are very hard to predict. So we actually sort of reject the idea of actually doing a specific expected return. And we sort of, and I'll show this specifically in my example for signal opposition, we sort of think of our job is trying to rank stocks relative to one another and pick stocks that are going to do well, but not make particular choices about exactly how well we think they're going to do in terms of a specific percentage on a specific day. So this has set the stage a little bit in terms of what I'm going to talk about, but I will say very clearly that actually Markowitz efficient frontier equation is not our solution to the problem. So let me go in a little bit to what is our solution. And I want to give it a little bit of context. Also, I mentioned this earlier, that not all of our customers are interested in trading directly with our portfolios, but many of them want access to some kind of measure, sort of these standard measures that will give them a sense of how well their models are doing. And so the core of our portfolio construction pipeline is actually a very quick, and you might say dirty model that tries to quickly give you an initial sense of how well the model is doing. So basically, we take the signal, the output of our machine learning. We can also think of it as a ranking of how well the stocks we think that various stocks are going to do in the future. And we pass it through. The first step first step of our process actually just to pass it through a filter where we say, you know what, let's not worry about all those stocks that we think are not going to do particularly well or particularly poorly. Let's just focus our efforts on our top ranked, and if we're doing short, if we have a long short model, our low ranked stocks. So we'd actually filter out a bunch of the stocks right off the top to get a compact set of stocks that we're going to be interested in doing investment on. This is sort of related to sort of answering a little bit some of the issues with that Markowitz equation, because of course, again, we move quickly away from that 1,000 by 1,000 matrix and sort of focus in on the stocks that we actually care about. Trusting our machine learning model to give us some good information that lets us narrow down the universe to something manageable. Then all we have to do is suggest, once we have a set of stocks that we're going to long and we're going to short, we just have to decide, well, what weights are we going to put on this? What's our allocation? There are a couple of options in our platform. The sort of maybe most standard options just to give them all equal weight. Though I'll show today that we may get a slightly better result if we actually bring the signals into play here and use the signals as a way of weighting the stock. So we're going to put more weight on higher stocks, but this is done in a very simple mathematical fashion. Just sort of say, if we have higher signals, we're going to give you higher weight. No optimization involved. And in fact, the very basic, simplest version of our portfolio construction is simply that. We filter, we weight. Here's a portfolio. And as I'll show in the results that I do in my experiment, that this actually works okay. Like you get good Sharpe, you get a solid model. But obviously this isn't really taking into account very much in terms of trying to mitigate risk, right? So the other pieces we're going to add on top of this sort of core pipeline are sort of going to increase the amount of sort of attention to risk. The first thing is what we call our main optimizer. So this main optimizer actually includes, I said we don't use the Markowitz equations directly, but we do use aspects of those equations in the context of our main optimizer. Importantly for that main optimizer, in order to bring in information about risk, we have to bring in some additional historical data and bring it to bear. This is sort of the stuff that basically feeds into those covariance matrices, the historical returns and stuff like that. And that will allow us to bring in some risk reduction into our model. We also potentially can use our signals and bring the signals in and try to do some trade-offs between them. And I'll be giving a little bit of evaluation of how the main optimizer works, even though that's not our main focus today. The other thing we can do with our historical data is we can try to summarize it. And so another part of our portfolio construction pipeline involves creating what we call risk factors. Now, in finance, there's sort of general well-known risk factors, things like momentum, value. I should say these are just general factors that people use. When I talk about factors in the context of this talk, I'm going to be focusing, though, particularly on a set of 10 of what we call machine factors. So machine factors, this is where the AI comes in. Machine factors are derived by summarizing this historical data into this, again, a small set of what we think are these key factors that are driving the market in recent days or well, recent times. 10 of them. And we can think of these factors, I don't want to go too deep into them because I'm going to show you an example of these on the next slide. But these factors basically, for every company, we can put for every stock, I should say, we can put a stock somewhere on a spectrum that corresponds to these factors. And so the two of the things that we can do with the factors are we can take, so we have companies on these spectrums, and we can use the risk factors directly as an additional filter on top of the signal filtering that we do, saying, okay, we don't want to have any stocks that are extreme on one particular risk factor. We can also apply these risk factors directly into the main optimizer. I'm not going to talk about that too much for two reasons. One, actually, some of what we're doing is very similar to what we'll do in signal optimization, so you're kind of already going to get a sense of that. And also, we've found, generally speaking, that if you're making good choices with your main optimizer, the risk factors, the effective risk factors on the main optimizer is not, it can work in some models, but it's not sort of standout. It doesn't have standout increase of performance. Where risk factors really comes into play and really adds benefit is in what we're going to, again, our focus today is signal optimization. So that's what I'm going to talk about next. So basically, what signal optimization does is, in the context of our pipeline, is it's taking these risk factors, which again are summaries of historical data that sort of represent what we see as the key dimensions, the key potentials for risk in the market, and it integrates that into the original brings that together with the original signals. We'll call them the original signals, and it puts those pieces of information together and derives a new set of signals that not only have the information from the original signal in it, but also try to make sure that we will be successful in mitigating risk using these signals. So it tries to bring in stocks or promote stocks that have potential to mitigate risk. And once we've done this optimization, we've created these optimized signals, we can use them in the same way we use the regular signals. We can run, and this is the way we definitely will always use them, is to run these signals through the filters instead of our original signals. So we get a different set of long and short stocks. We can also apply those signals to weighting. And this is an option that we might have, and we might choose to do this or not. And we could also potentially use them in the context of the main optimizer as well, though we're not going to look at that in this context. Okay, so this is kind of, now that you see the whole thing, it seems like it's a bit complex, but I wanted to sort of say it starts from a very sort of simple core, and then we're sort of adding pieces on top of it a little bit to sort of give people who care more about creating the best portfolio options to do so. That's sort of been our philosophy in terms of constructing, building our portfolio construction pipeline. Okay, let me go into the details of the signal optimizer. So I'm actually sort of misusing the term a little bit, because signal optimization you could do other kinds of signal optimization than the kind we're talking about here. We're talking about a specific sort of signal optimization known as factor neutralization. And it's also a minimization. And it can, in some of the same senses that are the Markowitz equation we talked about, but it's different in a key way that it's very, so we gave you a single equation there, but for a signal optimizer, there's an equation, there's a goal, but there's also what we call sort of something that we're trying to optimize, something we're trying to minimize, but there's also a constraint that we're placing on the model to try. It has to satisfy this constraint to give us a good solution. So it's kind of funny that it seems almost that the signal, like, it's a little bit like it's actually kind of lazy. So the goal of the signal optimizer, its objective function is to do nothing. It wants to preserve the original ranking of the stocks. We have state-of-the-art machine learning. We want to make sure that we try to preserve that state-of-the-art machine learning, to preserve the signal and make sure that we're picking the best stocks and using those and giving those high weight. However, we have a constraint on that process that requires usually us to make some kind of change. And the constraint is probably the hardest. It's not a particularly mathematically complex constraint. In fact, I didn't even put an equation on the slide, but it may take a little bit of work and I'm going to do it in two steps. First, I'm going to give you the high level thing, and then we're going to work through an example and show the sort of aspects of the example that should give you a pretty good sense of what this constraint means. So on the right hand side here, we have, this is going to represent like a ranking, our original signals coming in. What does our machine learning model think about each of these stocks? And this gives us information about on one particular factor spectrum. Again, there are going to be actually 10 of these, but we're only, the simplicity for just this model, for this example, we're going to just focus on there being one. This gives us information, but on this particular factor dimension, factor spectrum, what are these, where are these companies on this spectrum? And so here's how our constraint works. So we are going to based on the information we have here, what's going to be our longs and what's going to be short. Again, we have this sort of filtering process where we cut off and we say, okay, these are going to be our longs, these are going to be our shorts. Using this information, we can we can basically do a sum of the factor scores that are coming from here. And what our goal is to make sure what we have to, what we have to accomplish to satisfy our constraints is to make sure that that sum falls between this upper and lower bound here. So particularly we're going to, and more specifically, we're going to sum the longs. Those will sort of be positive. We're going to subtract the shorts, and what we get should fall in here. Let me get into my example, so it should make it fairly clear. So this example's kind of a fun example. It almost feels outdated after yesterday, but remember when we worried about the pandemic? Maybe that was the thing that bothered us most of all. So this is actually an example of a pandemic factor that we found. This is from a real model. This is using, so one of the aspects of our platform is we actually allow you to have these factors, and we let you sort of see what these factors mean. We derive them bottom up from the data. We don't impose, these factors don't a priority mean anything, but based on what we see in the factor, we then derive some interpretation. We call it semantic rich factors, an interpretation of that factor. So this is one particular factor that I pulled out. It's machine one, which actually means it's a very important factor. And taking a look at it, hopefully you can see that it's a pandemic factor. So basically, it's a factor that sort of is the spectrum that's on here is the one between sort of people going out and traveling and doing things versus on this end people staying at home and doing things through their computer, right? And so yes, this falls out of this actually is a real factor that fell out of the data. I want to just make one quick little note here. This is relevant also to what's happening. Notice I have this sort of double arrow here. So we use this term risk factor group A and risk group B. It's very important when you're looking at these factors to understand that there isn't one factor, one group that's sort of like the positive factor, like the thing that we should invest in to make more money. That's not how this is created. What this is all about is correlation and anti-correlation. It's all about these stocks will tend to move together, these stocks will tend to move together, and these pairs will tend to move in opposite directions. We don't know which direction we're going in based on what we're doing here. In fact, the whole point of what we're doing is to mitigate against the possibility that suddenly the directionality that we're seeing in one sense will suddenly reverse. So, and we've seen this many times throughout the pandemic where it looks like things are getting better. Maybe the airline and cruise lines are going to suddenly, jump back. But then, oh no, we've got, and we know that these things tend to move together. We want to mitigate against sharp movements in either direction among either sets of stocks here. Okay, so let's show how signal optimization does that. So now I said that this is based on a true story. The actual numbers on this thing are completely made up. So apologies if you happen to be invested in B of A and G. Yeah, I picked them because they're short and everyone knows them. So don't do any trading strategies based on these numbers. I just picked ones. I picked some stocks that fit well into either of these one of these two risk groups or not at all. Okay, so what does this mean? So it means that what is this signal rate? It means that based on the ranking that we're getting from the machine learning, we would probably choose to go long on Microsoft and the Gap. We would go short on B of A and GE, and we would choose not to do anything at all about Delta and Zoom. Again, this is not a realistic model. This is just an example. We would never trade with these set of 6 stocks. It makes no sense, but I just wanted to sort of make it sort of accessible to you how this is working. So our factor scores based on what these companies mean. So Microsoft and Zoom are both tech companies, and they're both particularly invested in one way or the other in the kinds of things that we talk about in risk group B. So this is the end of the factor spectrum that represents risk group B. And then Delta here, Delta Airlines is our low representative risk group A. And then the other 3 stocks, we're sort of putting them in the middle. They don't really play a role in this factor, maybe in small ways, but generally we can consider them as sort of being inert in terms of this factor. Okay, so again, our goal is to not do anything at all, but we might want, but we have to see whether we're satisfying our constraint. If we are, we're done. So let's do the math really quickly. It means not really any math because I didn't actually put the numbers on this, but so we take the longs and we look at their factor scores. So Microsoft has a pretty high factor score on this end of the spectrum. Gap, 0. So that's the longs. And then we subtract the shorts. Well, the shorts is pretty close to 0. The G is, they're all pretty close to 0. So really the only one playing any role in our in our calculation for our constraint is Microsoft. And so that bad news is because Microsoft is very extreme on this factor dimension, it means that we are not satisfying our constraint. We are above our upper bound, and this is not a valid solution to our signal optimization. So we have to try something different. And so I'll give you just a little moment here now that you hopefully understand the problem to quickly decide what you think we should do to solve this problem. How should we change the signal rank? How should we change our signals in order to have it so that we actually satisfy our factor constraint? Okay, the answer, there's actually two answers. This is the first one. So the first option here is that we could actually move delta from our sort of neutral, not going either way on, up into our logs. What's the effect of that? Well, because delta is on the opposite end of this factor spectrum, if we now can take so when we calculate the part for the longs, we take Microsoft and we add delta. So I put a 0 here to make it clear that although we shouldn't think of factors as being positive and negative quite the same sense as, like, upward market movement and downward market movement. Nevertheless, in terms of calculating factors, we can think of delta as being negative, Microsoft as being positive. When we sum those two factor scores together, that will put us nicely in the middle between this upper and lower bound. So if we just make this one switch to our signal rank, we will get we will satisfy our constraint, and we will be able to say this is a valid solution to our signal optimization. We'll have a new rank. Our optimizable rank will consist of delta in the longs and the gap in the shorts. What's the other solution? Well, it involves, sorry, I didn't mean to say shorts. The gap will be in the neutrals. The other way to solve this problem involves the shorts. We can take zoom and we could maybe downgrade it, lower its ranking a little bit to get it to our short cutoff, so that now, so I remember I said that we take the longs and we subtract the short. So Microsoft is in the long, and then we subtract what's in the short. If zoom is in the short, then we can take Microsoft, subtract zoom, and that will put us somewhere in this upper and lower bound range. So again, so that's how it works. Now imagine this, of course, with 10 factors and 500 stocks, and it actually gets quite complicated. It actually is the single most difficult optimization problem that's contained in our portfolio construction, more challenging than actually the main optimizer in many cases, certainly in terms of time. But it, as we'll show in a second with the experiments, it does a pretty good job of creating potential for mitigating risk. Okay, I think I want to move on to the experiments now. So first of all, I want to say, I actually was not involved with creating signal optimization. I came into this project more as an auditor, and I was running a lot of experiments looking at how our portfolio construction pipeline is working. So for that process, I collected a group of models. These are actual real existing models. They're models that have been running on our platform. And I wanted to use them as sort of test cases for evaluating whether or not our portfolio construction pipeline was working well. So I particularly chose this set of models. So they do represent a variety of stock universes. So I say we do have a bias towards the S&P 500. There's several models that have it, but we also have models that represent other North American indexes. We have a couple of European and also Asian stocks in there as well. We have not only just general sort of broad indexes, but we also have a couple of sector-specific models in there, including like a tech model and an industrials model, things like that. So for the results I'm going to present today, I'm going to break down these 14 models into two size groups, and hopefully it'll become clear as I go along why I did that. But I want to sort of up top sort of mention so first of all, let me say that the smaller size tend to be in the order of 200 stocks in the universe, whereas the larger size gravitate around more like 500 stocks. And breaking them down allows you to sort of evaluate these two separately. Most of the time we'll see, of course, hopefully, that they pattern similarly, that the sorts of techniques we use will work for both. But we also see interesting differences. And I wanted to sort of, off the top, to help you interpret some of the results I'm going to show you, I want to sort of give you a sense of the sort of key difference between these two different kinds of stock universes, large versus small, we've noticed that large universe, relatively large, I'm going to call them medium because they're even bigger models that we didn't involve in this experiment. They tend to be very amenable to strong reduction in risk and strong signal optimization. You get in terms of overall risk return sharp, you get a good benefit, you get a large benefit from strongly focusing on risk reduction. However, for smaller models, we found that they are a little bit less inclined to this, that many of the choices we need to make need to keep in track, try to keep alpha, have a stronger focus on the alpha side of that equation. So as I go through the results, I'll sort of show how this comes up in a number of different ways as we go through results. So the way that we're doing this ultimately is we're taking all these models, we're going to be changing some of the settings on these models, and we're going to be running them through the pipeline using historical data. Most of these models have about 10 years of historical data, and we're going to evaluate how they did using standard measures of risk, of return, i.e. alpha, risk, i.e. standard deviation. And then what we're really focusing most on is Sharpe, where we're trying to find a good trade-off between our return and risk. Okay, so the first set of results I'm going to show you actually don't involve signal optimization. So as I was doing this general exploration of our portfolio construction space, I found that there were other aspects of the experiment, of the other settings that we could choose that had a large effect on how things work. And across the models that we have, there's a lot of variation in these properties. So what I did is I wanted to sort of try to create, being a good scientist, I wanted to sort of control my variables and create consistent settings for my experiment. So I decided to choose one main optimizer and one initial weighting across all of the experiments that I run. And so I wanted to give you a little bit of results using related to the choice of optimizer and weighting to sort of justify those choices. So for the optimizer, we're going to use our reduce risk optimizer, which is focused purely, I should say, on, in the context that it's running, on reducing risk, lowering volatility. And I compare it in this first table here, I compare it to other strategies. So no optimization is sort of that idea of sort of skipping the whole main optimizer entirely and going straight to a portfolio after initial weighting. And it gives actually one of our highest alphas, which makes sense because it doesn't really have any sense of risk. It's just purely saying, what did the machine model think is going to work well? Good. What individual stocks are going to do well? Good. I'll take those in and use them directly. Now, our model does have an optimizer that focuses on an alpha. And I did want to sort of show these results because it's interesting. You can, if you run our max alpha, use the version 2 version if you're using our platform. It's better. It will give you an increase in alpha, but at a fairly significant cost in risk. And you can see the Sharpe has dropped. So lo and behold, Marquez was right. You know, we're moving too far along our curve and we're losing the benefits that we're getting from trying to trade off risk return. The other kind of surprising result, and this is a result we've replicated several times, and it's actually almost frustrating to us because we've tried very hard to build an optimizer that does a good max, that focuses on a Sharpe and tries to get a good maximizing the Sharpe value of portfolios. And we found through all of our experiments and multiple iterations of this, that it's actually, under our particular circumstances, it's very difficult to build a maximizer of Sharpe that actually does better on Sharpe than just purely focusing on volatility, which is kind of surprising. And one of the reasons I had to tell you about the entire model is it only makes sense in the context of the way that we approach portfolio construction, which is that we do this initial filtering based on purely on the signals, at least without signal optimization, purely on the signals. And because we right up the top, we get rid of a lot of stocks that are sort of outside and we only have a small set of stocks that we already know are sort of among our top or lowest for shorting performers. And then we are running our optimization only on the stocks that we've chosen. And under those circumstances, it turns out that it's actually best to have an optimizer that focuses purely or nearly purely on reducing risk. We've already brought in a lot of the signal information simply by picking a small basket of stocks that we're already saying these are good stocks. So we use reduced risk. It's our default in our platform, and we use it consistently also throughout these experiments. The other thing that you saw in our original sort of one of the core aspects of our portfolio construction pipeline is that we have to do this initial weighting of our things. Now, it turns out that this weighting actually matters quite a bit. It's kind of one of the dirty secrets of doing portfolio optimization is that you say you want to, that equation suggests like you're going to find this perfect single minimum value. But the truth is the techniques that one uses to optimize these equations actually result in the original, the start place you start in actually has a significant effect on the results. And we actually see that in these results here. And we do, this is using the main optimizer, but also doing weighting. And we see fairly different results between using alpha weighting as a starting point, which is again, alpha weighting using our signals, and versus equal weighting. Market cap generally does quite poorly, and we generally don't recommend you use that. But between alpha and equal, there's sort of some interesting things going on. So for small portfolios, alpha is definitely preferred. And this sort of gets back to that point I made where, alpha is, these smaller portfolios really like, they're kind of alpha biased. To get good Sharpe, you need to be kind of focused a little bit more on alpha. And so that's coming through here. Whereas medium portfolios, it's not really that clear. Both, they do slight preference for equal, but basically you can do either or equal, alpha or equal for the programs and get similar alpha scores. The main concern here is whether you want higher alpha, which you get if you do alpha weighting, or whether you care more about risk, which means you would probably want to do the equal weighting. But we're going to use for all of our experiments here the alpha weighting, since it works best for the small portfolios, and then by extension over our entire set. Okay, so let's actually present some results here with signal optimization. So I wanted to clarify something that we have done a little bit behind the scenes here. These are results using good settings, and I'm going to show you a little bit in the next couple of slides what these good settings are and how we found them. But these are results using our best settings across the two sets of portfolios that we're using. And there's one sort of interesting option here that I want to show that we have, and then we have available in our platform, is that we can decide whether you want to use the optimized signals when you're doing the alpha, the alpha weighting. So creating the individual weights. Generally speaking, using the optimized, if you use these new optimized signal for alpha weighting, that will increase the effect of signal optimization. You're sort of biasing the model more towards those solutions that are sort of the more risk-averse solutions. And so generally speaking, what we saw in our results here, so first of all, we see quite a significant improvement, particularly in these larger portfolios, the medium portfolios in terms of Sharpe. We get a nice, basically almost 0.3 Sharpe increase in these programs, and then also a nice increase in the small portfolios, but again, not as significant. Again, those larger portfolios seem to benefit most from doing signal optimization. Between these two options, not surprisingly, again, small portfolios we are a little bit more hesitant to apply strong signal optimization, and indeed choosing the option which has lower, which is sort of less intense signal optimization, which is to say the original signal weights work better for small portfolios, but then for medium portfolios, the reverse was true. So again, this sort of distinction between the small and medium portfolios. It's not overall, the results are consistent, signal optimization works, but the actual specifics for individual portfolios is quite different. So I mentioned that we have actually 10 factors that we use that were derived using our risk factors. I don't know if I mentioned directly, but there's actually sort of a natural progression to these factors that they're sort of become, sorry, I hate to do this during a talk, but it's actually decreasing. So the most important factor is actually the first factor is the most important factor, and then they will become less important as you go along. And so the question becomes, when do you stop? Do you use all factors, or do you just use some portion of them, the first n number of them? And when we ran some experiments doing this, and we found that actually when you do have larger universes, you're probably going to want to use all of your factors. Larger universes are complex. There's a lot going on, and you want to be able to capture all that information in as many factors as we have available. However, we found for smaller, so that's this sort of line going up here. But for smaller universes, the results are more mixed. You probably want to use less, and you may want to do some more experimentation with your portfolio to find out what would be the best factor to use. Generally, we always see increases up to about 3 or 4. After that, it becomes a little bit more dicey. The other main setting that we can choose when we're doing signal optimization are these bounds. So we saw what the effect of these bounds in the context of the equations, the example that I gave you. Basically, if we take the bounds and we do lower bounds, we're basically squeezing down that little range which we can fit into, and the effect of it is to sort of increase the amount of factor neutralization that we're doing, the amount of signal optimization that we're doing. What we found when we tried different bounds for our test set was that for these larger portfolios, you can really see it here. There is a little bit of an increase up to number 10, but it's barely visible. Basically, the larger portfolios seem to be able to adapt to whatever bounds you give it, and only when you go really extreme do things drop off. We've changed actually recently our signal optimization so the default bound is actually 10, so it works well with these medium portfolios. For smaller portfolios, that's a little bit more, a little bit messier. And I'm going to sort of summarize what's going on here, and to help you understand why we get these mixed results. So I told you that optimizing the signal weights makes signal optimization stronger, and if you do that and you set low bounds, also makes signal optimization stronger. That tends to be too strong if you're building this for a smaller portfolio. On the flip side, if you do original signal weights, which is a weaker choice for signal optimization, and you put your bounds too high, you end up with signal optimization that's too weak and actually has almost no effect at all. If you set your bounds really, really high, then there's no constraints on the thing, and it will just stick with the signals that it started with, right? So for smaller portfolios, you really need to be sort of careful about smaller portfolios in particular. You need to be careful about choosing these settings and find one that works for you. I also want to mention for smaller portfolios, because they're very sensitive to these settings, that we actually found that if you want to sort of tweak your alpha and your standard deviation, you can do that directly using these bounds. Like if you increase the bounds, you will, if you increase your bounds, you will increase volatility and also increase your alpha. It's more or less a sort of a direct relationship going up for both alpha and standard deviation. So this is one option you have in our model to sort of fiddle around with your trade-off between risk and return. Okay, I'm getting to the point where I want to start answering questions. So I'm going to just briefly mention we got some negative results trying with long-only models. If someone asks a question about this, I'm happy to answer. But generally, we found that long-only models don't get the benefits in signal optimization that long-short models do. Though there's maybe a little bit of there with the S&P 500, but generally, be very careful about using long-only models with signal optimization. You may not get the results that you expect. Okay, so let me just briefly conclude. So I've introduced today's signal optimization, which is generally an alternative approach to finding. So we're going along the efficient frontier, trying to find a good risk-return trade-off. And this is one that particularly that we can build in to our portfolio construction pipeline as sort of an additional sort of pre-processing step in some sense to our signals. That doesn't immediately create a extremely difficult, for people who just want to do simple portfolios, they can do it, but then there's sort of an option on top that you could add on top of it. So I showed you the details of it. Basically, the idea is we don't want to change our signal at all, but we want to try to maybe promote some stocks either into our longs or short that have the potential to mitigate risk. We saw in the experiments I showed significant improvements in Sharpe. These are gains I should mention on top of using our main optimizer. So we saw the gains from the main optimizer in that first table, and then we get additional gains on top of that using signal optimization. One of the things I wanted to sort of point out and sort of make clear to everyone that by doing this sort of trade, breaking down our portfolios into long and short, was to show how the relevant properties of the universe actually have a real can have a significant effect. And so one of the things that we sort of talk about why we sort of believe that having a platform like this is really useful is that you can run experiments. You can try different variations. You can figure out what works for the particular kind of investment that you're doing. One of the negatives of using signal optimization for this is that actually it is, because it's the most computationally complex element of portfolio construction, it also is actually the slowest. And we're actually very aware of that issue. And so actually sort of talking a little bit about future work, one of the things we're working on as an active project is to speed up things like signal optimization so that you will be able to do more experimentation with our platform using signal optimization in the future. Okay, that's the end of my prepared remarks. I can take some questions.
Thank you, Julian. Wonderful presentation, and we have a lot of questions. Let's try to get through most of them with the time we have at hand. First one, how does your model deal with extreme moves, that is non-stationarity?
Okay, so there's a couple of layers of this that I could talk to in this question. So one of them relates to the idea. So you meant the question mentions non-stationarity, which is when I hear non-stationarity, I think of time series models which are trying to predict particular returns on a particular day. And so when I brought up in the context of the Markowitz equation the idea that we're sort of a little bit, we're not a total fans of the idea of doing strict predictions of exact predictions of particular returns on particular days, that sort of somewhat answers that question in that sense, is that we don't worry if you are trying to model very specifically what number, like a specific return value specific day, you do need to be very concerned about issues of non-stationarity, the change in means, change in standard deviations. If you're not, you can, some of the issues that the sort of traditional models don't really come into play in the kinds of models that we work with. So from that perspective, pure non-stationarity is an issue. Now, there's a general problem. How do we deal with issues of, sudden regime changes, right? And I think we just had one yesterday, right, or the last couple of days. Of course, one of the answers is exactly what I talked about today, signal optimization. So signal optimization, and I showed you this in the context of the pandemic stuff, it allows you to sort of identify some of these patterns of stocks moving together or apart and tries to create portfolios that ultimately will mitigate your risk. So, I mean, that's the answer. You have to mitigate your risk. But a sort of a deeper question there, of course, is how do we mitigate our risk and keep it sort of up to date, right? Like how do we sort of know when we have a regime change and how do we sort of react to it? And I mean, the answer is in how we take that historical data, at least in the context of signal optimization, the answer is how do we take that historical data and turn it into the risk factors? And we've actually spent a lot of time sort of playing with this thing, and we actually are, this is sort of an active area of research in the company to be sure, sort of how do we offset the sort of desire to quickly adapt to changing market conditions, which we want to do. And our models do that. If some of you can see how, you can look at our sort of how we reacted to the pandemic and how the factors have changed in reaction to the pandemic. But also there are other things that stay quite similar over time. And we may not want to overreact to certain kinds of changes. We are not, our models are intended to be relatively long-term models. We're not day traders. We want to build models that are working within a larger investment horizon, and we don't want to react too quickly to sudden market shifts. But I think that in the core of it, if you deal well with sort of central market factors that we're talking about as derived from historical data, and you do a good job of figuring out what those are, you are natural and integrated into your product, into your portfolio via signal optimization or the other options that I mentioned. That will give you a certain amount of protection against these kinds of sudden shifts in the market, to the extent that is possible. Of course, it's not possible necessarily to always be winners, but we can help you certainly by mitigating risk, by lowering that standard deviation. We are hopefully helping you to avoid being a significant loser.
Thank you, Julian. Next question asks, when you talk about optimizer, are you referring to a standard machine learning optimizer, or is it custom built?
So there are, I should say there's sort of a couple of layers to the optimizer. We do make use of off-the-shelf optimizers in the sense of like general optimizers, sort of highly optimized. And we actually are considering changing optimizers. So that's something I was looking at a few weeks ago. But we do use sort of standard off-the-shelf optimizers for like, I mean, there's the actual equations that we use, the equations that we use for either our main optimizer and the particular constraints, the particular objective functions, our goals are customized, but the core optimizers are these standard ones that are very, very efficient. So I think that answers your question. So at the very low level, we use industry standard sort of optimizers, but we also have, of course, our own layer of customization on top of that.
Thank you. Is signal optimization tweaking the actual data and introducing bias?
Well, you say data, I guess it's tweaking the signals. So the signals are ours, right? I mean, the signals are the output of our machine learning module. We are changing those signals in the sense that we're saying, you know what? I don't want to misbelieve you. You say these stocks are going to go, but maybe we don't want to have all top 5 of our top stocks all be tech stocks or whatever, right? So it's saying like the signals, we are introducing a bias. We're introducing a bias towards stocks that we believe are going to allow for lower volatility. But there, I mean, yes, there's a sort of a fundamental biasing that we're doing. Without it, our model would be probably too focused. If you're in a pure model, our models are focused very much on maximizing return, which of course is what we want to do. But yeah, if we're biasing the model towards stocks that will allow us to reduce the risk, and I guess it is a bias, but I don't think it's a bad bias, especially if your metric of interest is sharp, in particular, of course.
Thank you. Is the signal optimized for alpha, relative performance, total returns, or just expected delta exposure to each factor?
So you're talking about is that the main optimizer or the signal optimizer? Sorry.
Signal optimizer. Like, what is the signal optimized towards? Is it just delta exposure to each factor, or things like alpha, relative performance, total returns, etc.?
It doesn't have any access to any of the sort of downstream. It's kind of an, I would say it sort of falls under, it's not trying to optimize things with a direct eye to either to returns, volatility, or Sharpe. It's simply trying to solve its equation, which is to optimize to as I say. So it is what I said. It's you take you're trying to keep the signal the same, as close to the same as possible, and you really just have this constraint. So the extent to which, so first of all, it implicitly by focusing on trying to keep the signal the way it is we know our machine learning models are optimized to try to improve alpha or something similar, and by doing that, it's trying to do what the machine learning model is doing. Its thing, but then it's bringing in the information, the risk factors, and the risk factors directly represent these dimensions of risk, and it's trying to say, well, let me try to avoid getting too risky on any one of these particular dimensions of risk. So I mean, but it's not directly optimizing for either alpha or standard deviation in that traditional thing. It's optimizing for sort of derivatives of those particular measures, if that makes sense.
Thank you. How successful is backtesting on historical data in providing lucrative predictions when accounting for new variables? Would you like to answer this?
I mean, I think that's kind of a general question. I mean, of course, that's kind of that's what our platform is all about. I mean, we want, in order to, for example, let me use it in the the context of what we're talking about today, which is I said, so by doing these experiments using backtest data, we were able to identify, in this particular case, the important setting change that needs to be made depending on the size of your universe. So I would say that backtests are very important for figuring out how for getting some initial settings for trying out some general options for how you're going to do your trading. And this is a great example of that in the signal optimizer. I think that's about as much as I want to answer that question. Sort of a more general question than I feel I can really address, especially in the context of the time that we have.
Thank you. Is a signal optimizer an integer optimizer?
Sorry, a what?
Is a signal optimizer an integer optimizer?
An end teacher optimizer?
Pardon me, integers?
I'm not sure if I even know the term. I think I might sort of.
No problem. We'll circle back.
I might skip that one. I might have already answered that. If it is what I think it is, I might have already answered that question a little bit with the one talking about how it's sort of the goals.
What is next question? What is the difference between sharp and sharp v2, alpha and alpha v2? I think we saw it on one of your slides.
Oh yeah, sorry. I should have really mentioned that a little more clearly. So we sort of done in the last, I should say, how long is it? It's been the last 6 months or so. We did another round of our optimizer. We made some changes to them. And so if you go into the platform, you'll see that we left the original optimizers in place, but we have these version 2 optimizers that we've shown are better at doing what they're supposed to be doing. So we did experiments and so the specific differences actually, I will mention, because it's sort of relevant to something I talked about, the original version of Max Alpha actually was focused more on that idea of actually predicting expected returns. And we found that didn't work as well as what we're doing now, which is more focusing directly on the ranking provided by the signal. So it's basically an evolution of our optimizers. Each of those optimizers is targeted a particular kind of variable, and we're trying to sort of do better versions of those. So generally, we recommend using the V2 ones. Now, you should see generally better results, or at least results more in line with what you're trying to optimize using those optimizers. Yeah.
Thank you. Does the complexity lead to overfitting when new data or stocks arise?
That's kind of a general question that, so new data, new stocks. So I'm not sure if I want to talk about how we sort of deal with new stocks getting into indexes. That's kind of a bit of a digression, though. I will say that the factors help us in this because we're sort of trying to summarize summarizing so when historical data, when a stock appears, a new stock appears, we don't know very much about it. But because if you're quickly able to sort of summarize these new stocks and quickly get them sort of into a category, when you do these kinds of methods, these unsupervised methods to sort of summarize this data, you can often get quicker results in terms of identifying a particular stock, sort of what kind of category it belongs into. Is it one of those risk group A, risk group B stocks but I think I want to avoid the overfitting question. I think, so our portfolio construction pipeline doesn't have too much of an overfitting problem because most of our methods are sort of unsupervised. We don't directly train in anything that I've talked about here, again, on alpha or on sharp even, in terms of using the future performance of these stocks. And so by doing that, we sort of, in the portfolio construction area, there's no particular concern in the kind of overfitting that you see in supervised machine learning models.
Thank you, Julian. Last 25 seconds, if you want to take this question, how does rebalancing affect the signal optimization model?
That's a good point. I maybe wasn't really clear about that. So signal optimization runs at every rebalance state, right? So we're basically that's actually one of the sort of technical and problems with keeping it fast. Is so every time, if you have a daily rebalance or something like that, you're running a new iteration of signal optimization every rebalance period, every rebalance day. And so, yeah, which is good. I mean, so we're keeping up to date, and we're keeping up to date both on the signal input and also in terms of the changes that are happening to our factors as we go day to day, because again, that's very fluid as we go through time. But yeah, we do have to redo signal optimization each time we do a rebalance.
Thank you. With that, we'll end. Thank you, Julian, for a wonderful presentation and a vibrant Q&A session. Thank you to our audience who took the time to attend. Have a great rest of the day, everybody.
Thanks, everybody. Thanks for coming.